Welcome to Taking Stock for the week ending 1st of September 2023, where myself, Tim Lincoln, and our head of Stock Doctor Research, Kien Trinh, stream to all things share market. Welcome, Kien. How are you?
Not too bad, Tim. It's been a very busy reporting season, no doubt, and we look forward over the next couple of weeks to bring in some emerging opportunities for our clients and members.
Oh, fantastic. That's on the top of all of the stocks you're obviously looking at in our traditional universe of star growth stocks, star income stocks, and borderline star growth stocks. So that's terrific. But yeah, well done to you and your team too, Kien, for really keeping our members totally informed and up to date with the ever-changing list of our star stocks. And really important that ourselves and our members stayed incredibly active in the constant management of our portfolio. So well done again. But just before we get into more about reporting season, Kien, just a reminder that all the information we share today is of a general nature, as obviously we haven't taken into account your personal situation and needs, and therefore should not be construed as personal advice. And all of the data charts and performance metrics that we share also are of an historical nature, and therefore should not be relied upon as a guide for future performance. So let's get into this bumper edition of Taking Stock, Kien. And today marks the first day of spring. So the buds and the flowers are starting to bloom, which is magnificent. And it also marks the end of the Australian reporting season. And with lingering inflationary cost pressures, weakening consumer spending, and higher interest costs, it was certainly a volatile period for stocks. So the month of August was just all over the place, wasn't it, Kien? And it ended up only being down 1%, but in the middle of August there, it was down 3, 4, 5% at times. But it looks like many businesses were able to navigate those conditions quite well, Kien, with most companies meeting market expectations. And what are your overall thoughts, Kien, as we wrap up reporting season?
Well, Tim, a few key themes really stood out. Overall, management guidance was weaker than previous reporting periods, and the uncertainty around the outlook had led consensus analysts to continue downgrading their earnings expectations. And you can see this with the chart on screen, which compares the earnings expectations in black with the All Ords index in blue. And if you can recall, prior to the reporting season, we did speak about the mismatch between the optimism in analyst earnings forecasts and leading economic indicators, signaling a period of weaker corporate earnings. And the other point also that I'd like to mention is that commodity prices are pulling back, with China facing weakening economic growth and also a debt crisis within their property market. And with major miners like BHP and Rio reporting lower profits and cutting their dividends, the resources cycle is turning. So investors should be mindful of having too much exposure to resources in your portfolio at this stage of the cycle.
Yeah, it's so important to remain diligent, isn't it, Kien? And as we touched on before, active in the management of our portfolios, because cycles and sectors and everything is constantly evolving and changing. So you've got to stay right on top of everything. And I also noticed, Kien, that overall the consumer retail sector performed much better than expected for this reporting season. This has led to a rally across many stocks like Nick Scali, JB Hi-Fi, Premier Investments, Wesfarmers, and Super Retail. And what's your view on that, Kien? Because it was a surprise.
Yeah, Tim, the retail sector, it was overall quite mixed though. Many other retailers performed dismally, including Adairs, for instance. We had City Chics and even Kathmandu. However, we are not convinced that the rally across the retail sector is sustainable. When you look at earnings expectations for those stocks, they were already low to begin with, and the outlook continues to be clouded with heightened risks around the lag impact of rate rises. And so be careful here. If you have exposure, make sure you focus on the businesses with strong market share. They've got to have a niche product, and they also have to have other growth avenues such as store rollouts and global expansion. And another major theme that came through, Tim, was the rise in interest costs, and that put significant pressure on companies with large debt profiles or those in financial distress. Interest costs have also impacted property stocks, which tend to have higher debt, Tim, but their valuations on the properties were also compressed as well.
Yeah, great advice, Kien, and it's a very important point, and as a key reason for the rise in the number of insolvencies over the year. In recent weeks, we note the collapse of nutrition retailer Halo Food Co. HLF is their code. Look them up in Stock Doctor and you'll see why they failed. And many investors were drawn into this captivating story, supported by rising consumer demand for health and sport nutrition products. Yet, despite the business generating $52 million in revenue over the last year, the stock collapsed, with investors losing absolutely everything. Easily avoided, and we do feel sorry for those that were exposed.
Yeah, that's a great case study, Tim. And monitoring financial health has helped investors also manage their portfolio risk over this reporting season. In fact, we did an analysis of the performance of the market. And during the reporting season, it suggested that businesses in strong financial health were less volatile and actually performed better during August than their financially weak counterparts. And this can be seen with the chart on screen, which splits the August performance of the different financial health categories within the ASX 300. And you can see here that stocks that were strong or satisfactory outperformed the market, while those in distress and marginal significantly detracted.
No need to speculate amongst those high-risk companies, Kien, is there? That's a really compelling chart. Great graphic. Thank you very much for sharing that and compiling it. And there are a few high-profile disappointments, which further emphasises this point too. Financially weak companies like big names, Amcor, Iris, once a star stock, a great star stock. Again, the importance of staying active because you never know when financial health can shift based on economic environments. Link Administration, corporate travel, and Insignia Financial were all punished this reporting season because of poor results. And moving forward with insolvencies on the rise, Kien, we believe financial health will continue to protect investors in the coming year. And moving on to some of our star stock highlights now, Kien, let's now focus on the positive end of investing, and that is constructing our portfolios with high quality businesses. And there were numerous results and announcements, so please feel free to refer to the analyst commentaries for full details. That's where we really, you've got the 9 golden rules, but really important too to read those analyst comments so you can get that full alignment to the rules and all of the active risks and more meat on the bone in regard to helping you make investment decisions. So let's start with star income stock and telecommunications provider Telstra, Kien. The result appeared solid, with growth in return on equity and net interest margins, supported by planned price increases and a lift in average revenue per user. So really good, strong metrics there. In fact, management outlook guidance was in line with market expectations, with earnings growth expected to improve by 12%. On the surface, looks really, really solid, Kien. But why was the stock hammered on the announcement of their results?
Yeah, very interesting one, Tim. The market was anticipating that Telstra would sell off its infrastructure assets, with the proceeds meant to fund a share buyback or special dividend. But this didn't really eventuate. Telstra has decided to retain its infrastructure business to assist with the demand for cloud storage and even artificial intelligence, Tim. And this in turn will give them more growth options and help support the expected increase in its dividend payments, with the stock now currently on a gross dividend yield of about 6.4%.
Well, excellent insights and good, strong rationale behind that volatile price on their announcement. Moving now to Brambles, Kien, the pallet and container pooling operator, recently announced their financial year 23 results as well, which were on top end of their own guidance, with net profit margins remaining intact at 10%. So pretty solid result for such a large company. The company operates a pool of 361 million pallets and containers under the CHEP brand, transporting goods to retailers to Australia, North America, and also Europe. Being a bellwether of the global economy, Kien, how has the business been able to defy the slower economic conditions?
Another good question, Tim. Actually, slowing consumer spending and shortages of pallets meant that like-for-like volumes were actually down 5%. And this led Brambles to produce more pallets, subsequently increasing their costs. Now, as those retailers begin to destock pallets, Brambles can allocate its resources more efficiently and potentially lead to an improvement in their return on equity.
Very interesting, Kien. And consensus currently expects earnings growth of around 18% in financial year 24, which is obviously really strong for, again, a business of its size. And Brambles remains a high-quality business, Kien, with the market power to continue increasing prices without impacting volume. So all very positive for them. Let's shift our focus now to management and planning software provider, Objective Corporation. The company witnessed a sell-off on its share price following its announcement of its financial year 23 results. And at first glance, the performance during the period seemed to align with consensus expectations. However, as we know, the devil is always in the detail. Can you provide some more insight here, please, Kien?
Certainly, Tim. Financial year 23 was a pivotal year for Objective Corp as it ceased selling its perpetual software licenses and shifted to a software as a service, otherwise known as SaaS model, with annual recurring revenue. But this only grew by about 10%, well below expectations of around 15%.
Okay, but earnings growth is expected to accelerate in FY24, as can be seen there in the under Golden Rule 3, and return on equity is forecast to rise back to 40%. So what's driving this future increase, Kien, and why is the market basically ignoring this?
Yes, starting from financial year 24, in conjunction with the cessation of perpetual license sales, Objective Corp will begin to capitalize 40 to 50% of their research and development expenditure. And this aligns with the peers as well and is expected to provide a boost to their earnings. So this is an alteration to their accounting policy instead of a fundamental improvement to their operations team.
Fantastic, Ian. And with the end of reporting season, it's lovely to look at our corporate calendar and see that the financial results have virtually dried up for our Star Growth Stock, Star Income and Borderlines, Kien. But I do note that there are a few companies going ex-dividend next week within our Star Growth Stocks, but obviously they're not there for the yield, so that's just a bonus. But more importantly, amongst our Star Income stocks, and we've got, just looking at the corporate calendar now, we've got NIB Holdings. They go on the 4th of the 9th. Then on the 7th of September, we've got the ASX, we've got Macmillan Shakespeare, Super Retail, and I believe that's it for the week of ex-dividend stocks. So it's wonderful for you to now look at that calendar, you and your team, I'm sure, Kien, and see that you've got a bit of clean air now to focus on constant improvements elsewhere. And now to Under the Microscope, Kien. And this week we take a look at borderline Star Growth Stock and Star Income Stock, our main exchange operator here, the ASX. A company that has really underperformed the market over the past year, Kien, really been hit hard from a share price perspective. But why did the market continue to punish the stock, even though its results were in line with expectations?
Yeah, Tim, the ASX reduced its dividend payout, and that was to release funds to support capital spending on technology and also compliance programs. And this comes fresh off the back of a bungled rollout of a new system to replace its aging CHESS infrastructure, which led to a 250 million write-down at the end of 2022. In addition, income investors didn't react too well to the lower dividend expectations at about 85 cents per share, translating to a rough gross dividend yield of around 5.5%.
Okay, good stuff, Kien. That makes a lot of sense. And I also noticed your team transitioned the ASX from a Star Growth Stock to a borderline Star Growth Stock. And I assume that that's because of the active risk remain quite elevated still. And there is uncertainty with regards to the increase in their spending, isn't there? In addition, regulators have placed the ASX under extra scrutiny with regards to its price controls and governance issues. So with all of those active risks still present, Kien, why did your team retain coverage at all?
Yeah, firstly, Tim, the management team is not the one responsible for its previous investment mistakes. And despite the risk, the business remains a monopoly with very strong margins, and they continue to benefit from the rising interest rate environment through the margin income. And also management have alluded to a growing pipeline of potential ASX listings.
Okay. And with the share price really coming under pressure over the last year or so, those who are trend sensitive to this type of situation should avoid the stock because it triggered an exit on the SD30 TSR back in October 2022. And with the stock trading at a slight discount now to its valuation under Golden Rule 5, and with that trading at a discount, Kien, do you view it as a potential investment opportunity for opportunistic investors?
For long-term investors, Tim, we believe the stock could represent opportunity, given that the share price appears to have factored in some of those heightened active risks. However, investors need to be mindful, though, that earnings for this stock is tied to market activity, which remains weak on the back of slowing economic conditions. And this is why earnings growth is expected to be flat over the next year. For income investors, though, the stock does go ex-dividend on the 7th of September.
And now to question of the week, Kien, and with reporting season now behind us, a question that is often asked by our members is which star stocks were the winners over the reporting season?
Well, Tim, to identify the winners and look for opportunities, you can use the stock filter under the tools menu. Here you can build a filter which includes all star stocks and add in fields including 1 year forecast earnings growth, 3-month earnings forecast revisions, also have the SD30 TSR status there, 3-month price change, even a valuation one like price to consensus target, and a number of consensus analysts just to make sure that your consensus figures have high conviction. But once you have that list, you can sort in order of earnings revisions, and stocks with the highest upgrades to forecast earnings estimates tends to be the ones that provide the strongest results and outlook guidance.
Yeah, great advice there, Kien, to use the stock filter, but you can also use the watch list in a similar way. Just go to the star stocks. The 3 categories of star stocks are listed there within the watch lists, and you can use either the growth view or income view for star stocks. And the stocks on these lists that once sorted by earnings revisions, Kien, I think stocks like Pro Medicus really pops out, Hub24, Hansen, Cochlear, Jumbo Interactive, NIB Holdings, Altium had a great result, and Net Wealth and Brambles.
Yeah, that's right. So those were the star winners during the reporting season. But note that many stocks with strong earnings upgrades have also experienced a strong rally as well, Tim. So here you can use those other fields like the SD30 TSR, the 3-month price change, or even the price to consensus targets to look for oversold opportunities. And sorting on price to consensus targets, for example, reveal that we've got Kelsian Group, Ridley Corp, which we recently introduced in the borderline star stock space, CSL, we've got Hansen, Objective Corp, Jumbo, GUD, and even Challenger as potential opportunities.
But before you invest, make sure you read our commentary. We touched on it earlier. The analyst commentary is there to really provide you with a consolidated view of everything, not only our rules and our quantitative metrics, but also the active risks and other observations that they also make in regard to the stocks that each analyst cover. So that's it for another Taking Stock here, and a bumper reporting season edition. And thanks very much, as always, for your contribution.
A pleasure, Tim, and look forward to the week ahead. And as I said, there's plenty of stocks now with emerging opportunities, but we just got to be careful with those stocks that are financially unhealthy after reporting season.
Absolutely. With this rising interest rate environment, we really still believe that interest rates are yet to really bite into the bottom line and of a lot of listed companies. So stay really vigilant with this, because we haven't been in this environment before. But it is a bit of a delayed effect, isn't it, Kien, in regard to the impact of rising interest rates on companies' financials. So really important. Just a reminder, the Lincoln Live, we're here on Monday mornings. So for the regulars, we look forward to seeing you there. But if you haven't tuned in before, please do so. It's a Q&A session where Kien, Matt Schwartz and Robbie Manfrey, we're there to answer all of your questions, stock strategies and anything else. We have a bit of fun there as well. Also on the 12th of September, we have the stock room where again we dive deeper into stocks and a big recap on the reporting season. Webinar goes for about an hour. Kien and his team and myself will be there. You can book into that via the corporate calendar. Just go across to the Lincoln events column and go down and select Lincoln Live, and off you go. And we'll also be sending out invites next week too. So love to see you in the stock room. But just a summary on today's taking stock, monitoring financial health is critically important, not only during reporting season, but ongoing with that rising interest rate environment. And with corporate earnings downgrades continuing now to flow through, make sure you use this period to reevaluate your portfolio and stick with those financially healthy businesses. Great being here with you all. Have a happy, healthy, and prosperous week.